Today, I'd like to talk about the most common types of financing that I've seen over my career in real estate. I've done each of these a time or two and want to kind of dig into some of the details of those. So the four types that we're going to go over today are seller finance, DSCR, which stands for debt service coverage ratio loans. We'll go through traditional financing, and then we'll go through subject to. So each of these has its own strengths, its own weaknesses, pros, cons, situations where you should or should not use them, and we'll go through those today. I'm cold today, so I have hot coffee to warm up my hands. I think they're trying to freeze me out of here. But let's start with traditional financing, right? It's what most of you guys are going to do or get with your first home. So traditional financing, there's a wide array of it. You might have heard of FHA loans, VA loans, conventional mortgages. So that's traditional financing. And there's a lot of federal regulations. The Dodd-Frank Act really tightened those up and forces certain debt to income ratios. It forces a lot of other criteria for you to qualify for those mortgages. We're still recording. I don't know why that went out. Anyway, maybe I can cut it, maybe I can't. If I cut it, great. If not, you got to see me in the middle of recording with very low battery on my camera. So traditional financing, right? Those are types of loans that you can get. VA, generally you can get 0% down. There are certain stipulations. There's a VA funding fee, but if you have a disability, right, a lot of times if you're 100% disabled, you get $0 funding fee, and it kind of works its way down, but that funding fee is well worth the 0% down, and generally you have very competitive interest rates. FHA loans, right, 3 to 5% down is generally what I like to say. 3.5% is usually where it lands. Conventional mortgages are going to be 20 to 30% down, depending on your bank and depending on your lendability, which is your income, your debts, the types of assets you might have in place. There's also a USDA loan, typically referred to as an RD loan or rural development loan, and that's in places that have a lower population, and it's 0% down as well. Great options, right? And I always recommend this for loans 1 through 10, right? The government will actually back most of these loans we just went over. So you have Freddie Mac, Ginnie Mae, and Fannie Mae, and those all are government entities that kind of back and support the mortgage industry. With that being said, let's run on over to, and they'll give you up to 10 of those loans. After 10, you're no longer lendable on conventional or traditional financing, if you will. DSCR. So debt service coverage ratio loans are for investment properties. All right, they generally require 20 to 30% down, and they are looking for a ratio of 1.2, which essentially that 1.2 is 1.2 of your PITI, so your principal, interest, taxes, and insurance. They want your rent or your income to be 1.2 times that. So if, let's say, your mortgage or your PITI was $1,000, they would want your rental income to be $1,200, right? So 1,000 times 1.2. And those are commonly used for buying investment properties. They do require the down payment of the 20 to 30% down. And sometimes you can put up to 50, if you need to put more down to get to that DSCR, you can, the ratio. So it might take 50% down for you to get to that 1.2. Some banks will come down to 1.15, 1.1, but generally 1.2, and that's a good benchmark for you too. I would never recommend trying to get below 1.2 unless you just have multiple exit strategies or you know something about the market, or it's a highly appreciating area, or if you have an option to split it, rezone it, something of that nature. We'll dig into that in some of my other videos too. The next one is actually subject to. This is a big, like, what do you call those words that are super popular? Buzzword. There we go. It's a buzzword, right? People either love it, hate it. It creates a lot of tension. I've bought subject to 3 times now. The most recent one was assuming. I don't want to say assuming. That's completely different. Assuming is where someone has a loan and you then apply for a new mortgage, but you're actually assuming their loan, so you get all their terms, but it transfers to your name. Subject to is you're actually buying the property subject to their mortgage, so it remains in the seller's name. You would kind of get login information for their mortgage. You would continue to make the payments, and you would own that home. The last one I did, they had a 2% interest rate, which was fantastic, unbelievable, really. And so, it's well worth it to get it subject to a 2%. You're able to give more money for those. I still bought it under market value, but so 2% is what I got, and I paid them cash for the difference of what I bought it for. So I bought it for $90,000. I think they owed about 75-ish, and that 75, out of that 75, I should say, the mortgage was maybe like 60. So if you can imagine, the mortgage was 60, right? They originally got the balance of 75. So I took on that mortgage of 60 at 2%, continued to make payments. I paid them the difference between the 60 and the 90. That was their cash out. The mortgage remained in their name. I took over making payments. Subject to is a great opportunity to kind of get a mortgage for a lower interest rate. Now, there's pros and cons. There's a due on sale clause for all loans of some type. There's some type of due on sale clause, which essentially means when the property is sold, the deed is transferred into a new name. A lot of times the mortgage company can say, hey, the mortgage is due on sale, right? So that means the entire balance is due to the bank. Now, the banks are not in the real estate industry. They're in the banking industry. So generally, they're not going to call it due unless you fall behind. I've never had it called due. People have. I don't have any experience with that, and that would be a very stressful situation, but you should always be prepared for that. Just like my last video, I kind of talked about be prepared for the unforeseen circumstances, okay? The last one, seller finance. This one's a great opportunity. I just got an email yesterday. I reached out to someone who said their seller might be offering seller finance. Their request was 30% down, okay, a 10-year note at 2% interest, which is quite unbelievable. Now, it's an overpriced property, so there's a lot of reasons not to move forward with it. But if we could get down to the right price on that property, that 2% interest rate is really, really appealing for 10 years. That's on a mobile home park. I've done another seller finance over in Eureka Springs for some lots. A gentleman just wanted to sell them, make it easy on everyone. And so we did a 60-month term. I think we did 5% interest on that. And then I did pay him off early, as it was 2 lots that I bought. Sold one, and so I was able to pay him off early. But 5% interest, 60 months. An attorney drew that up for us. It cost about $1,200. So nothing too wild, and then no banks involved. Now, if there's a mortgage on the property, right, you do have to be cautious. Always go through a title company, get them to do a title search, make sure there's no liens on the property. That's a dangerous place to be. So just do your due diligence, I always say. I was working on a seller finance deal in Oklahoma, and I won't give too many details, but I lost money on this deal, and I was trying to trade personal property for real property. So personal property being a vehicle and some